John McCluskey, the President and Chief Executive Officer of Alamos Gold. We're a diversified gold producer with operations in Canada and Mexico. We generate 600,000 ounces of annual production, and we've got a growth profile that'll take us to 1 million ounces of production by the end of the 2020s.
John, good to see you here.
Thank you.
We saw you in London almost a year ago. A lot of things have changed, not least the market for gold at the moment. How are you reading it?
I think it's as positive an environment as I've seen in my career. You know, everything is lining up for what I would consider to be a lengthy and very bullish run for gold.
Right. Now, you can control what you can control, but it's nice to have that kind of high-priced gold environment in the backdrop. What has that done in terms of the business plan for you guys? Is it steady as she goes?
Well, what it's done is it's providing increasing margins. You know, we've been one of the few companies that's kept costs flat while the gold price has been rising. So we're generating a lot more free cash flow. And we've done that ahead of the pack. There's only been a couple of companies over the last few quarters that have been able to demonstrate that margin expansion.
Yeah.
I think as time goes on, with the way the gold price is moving, you'll see more companies doing that. But we were one of the very early companies within the sector to deliver on that margin expansion. With that, it allows us to fully fund our internal growth. So when you can internally fund a very aggressive growth platform, you're in great shape.
I mentioned this kind of contrarian status that you have in terms of the assets that you picked up back in, was it 15, 16, 17-ish? You buck the trend. You're behaving, well, in a contrarian manner. But you're continuing to do that now, in the sense that you're not going out and like these sort of, we're seeing lots of majors doing deals, mergers of equals, et cetera, et cetera. You want to focus on what, organic?
Correct. I mean, we have been as aggressive as anyone on the M&A front, but we just behave in a very counter-cyclical manner. So when the gold price was at the bottom, we were aggressively acquiring. And of course, that is not a very popular move. You'd think it would be, but it's not.
Yeah.
But the net result is it's set us up for a tremendous amount of growth between now and the end of the 2020s. I mean, all that growth is coming from assets that we acquired during the downturn. Now, it's not like we're completely adverse to doing deals at any given time in the market if we can see value. So for example, we announced a deal in April to acquire Argonaut Gold. Why would we do that? You know, with the gold price breaking out, you'd think that company would be sort of trading towards the top of its chart, you know, given the way things are going. That wasn't the case. Gold price was breaking out, but because of the internal difficulties that Argonaut was having, their price had actually come way down. It had come down from roughly $4 a share. I think it was there in 2020 or so. It was at about 30 cents a share. And so they poured about $1 billion of capital into the development of the Magino mine. The Magino mine is located adjoining our primary project, our Island Gold project. So there was 4 million ounces sitting on our doorstep in a fully permitted, developed open pit operation. And, you know, we just had to take advantage of that opportunity. They were looking for a buyer. They knocked on our door. Within a very short period of time, we were able to conclude terms, and we closed that deal in July. So we added value in a very strategic way, an asset right on our doorstep, lots of ounces, a lot of capital had gone in. In other words, there's tremendous optionality for us in that transaction.
I mean, considering the location, that's probably worth more to you than others.
It was.
Suspects, and moving quickly is essential.
Absolutely was, yeah.
Yeah, because it kind of feels like right now we're super excited about $2,500, $2,600 gold, but back then, beginning of the year, it was just, where were we, 2.2? So that's
2,100.
Yeah, 2,100.
Yeah.
It wasn't quite enough to get people, they were looking, but they were not quite enough to get people doing, it seemed.
Well, in the case of Magino, it was a very, very unique situation where we were in the process of a big expansion at Island Gold. So we're sinking a shaft right now. We're going to turn that from a ramp operation into a shaft-driven operation. And why we're doing that is we acquired the asset when it had less than 1 million ounces of reserves, and now reserves have grown to over 6 million ounces because we've been so successful with drilling there. It's continuing to grow. So this shaft development concept was just perfectly suited the success that we're having there. But in addition to the shaft, we also needed to have a mill that capable of twice the capacity that our current mill has.
Okay.
We were right at the doorstep of that mill development when the opportunity to acquire Magino came around. Well, Magino's sitting there with a 10,000 ton per day mill, and where there's plenty of capacity to handle all the Magino ore and our ore. So we worked out that the synergies in that transaction for us, not anybody else, but for us, was roughly $500 million. Just the synergies. And that's not an exaggerated number. That's a very hard number that every analyst on the street looked at, scrutinized, and agreed with. Over and above that, because that company had achieved permitting across a lot of really key areas, including mill expansion, that mill can go to 35,000 tons a day. It's fully permitted to do that. They'd also permitted about 150 million tons of tailings capacity, far beyond anything that both those ore bodies combined is going to require. That to us represented huge optionality, and we bought into that. And we initially saw a quick bump in our stock off the back of the synergies that we gained, but I think it's a slower burn, and you'll watch us over time start to gain from the optionality side of that deal.
Well, I'm just so intrigued by this moving from 600,000 to 1 million ounces in an environment like we're seeing at the moment. What that's going to do for you as a business in terms of the, I guess, institutional interest? Because I find this coming from from the tech space, etc. Looking in here, it's a tiny industry that we're in. Do you think that we need more companies like yourself of that sort of level to kind of draw this institutional cash back into the space?
I think investors are telling you that they like our strategy. What do they like about it? Well, we're investing our capital wisely. Our return on capital is among the best in the industry. We're investing in productivity. In other words, the kind of things we're investing in brings our costs down. So we look ahead in the next 5 years, and in an inflationary environment, we see our costs continuing to drop. That is a real exception in the industry right now. So reserves. We're in an industry where, the majority of our competitors, certainly the major companies, are really fighting declining reserves. And they're addressing it in any number of ways. You're seeing the very big companies starting to diversify into copper, for example. That's a way of keeping up long-term cash flow in an environment where it's just very difficult to find gold. We are not facing that problem. We're watching our reserves grow at quite a dramatic pace. Put that in perspective, when we started this acquisition trail back in 2015, prior to our first deal, we were sitting on less than 2 million ounces of reserves. Off the back of this latest acquisition, our reserves are approaching 13.5 million ounces. That's tremendous reserve growth. That's net of all the depletion. That's all net of all the mining that we've been doing. We've been mining at around 500,000 ounces a year. So, this is the type of, bucking the trend that really matters to investors.
But and do you think you're fully valued as a result of that at the moment? Or do you think, talk to me about growth. What growth?
That is such a loaded term, that fully valued term. Because, the minute you say, oh yes, I'm fully valued, then people should sell the stock. I should sell my stock. But by no means are we fully valued. I mean, we're a freight train coming down the line at a very rapid clip. And, no sooner do we publish, one update on reserves, which we did at the end of last year. That's 6 million ounces. By the end of this year, I'm talking about at Island Gold, we'll be at 7 million ounces at Island Gold. How are we doing that? Well, we're investing $60 million across our operations in exploration this year. And we're finding gold everywhere we're looking. We have 4 different areas. We have the Island Gold Complex that's made up of 2 mines. And then you take Young-Davidson, Lynn Lake, and Mulatos. On every front, we're finding more gold. So how can you be fully valued? The only way you can be fully valued is if the whole thing stopped and you said, okay, take a measure of where they are. We're better valued than our peers. Why? Because we're executing better. Our success rate of finding reserves is far higher. Our margins are bigger, and our margins are growing. That's why we have a better valuation. But saying that we have a better valuation than our peers is not saying we're fully valued.
Okay.
People have been saying we're fully valued since we've been a $100 million market cap company. That was how long ago? That was probably 16 years ago. We've gone over that period of time from 100 million. Today we're sitting at over 11 billion. So at which point in that time were we fully valued? We no sooner heard somebody say that than we jumped another 500 million. You see what I mean? And that's my, when I look at our company, that's the kind of thing that keeps me excited about it. We are constantly pushing through every sort of threshold, every estimate that the analyst group puts out on us. We break through that, and they have to set new ones.
Okay, so the ambition and the aggression is still there. That's
aggression is a pretty strong word, but hey, we are a very ambitious company, and and we have clearly outperformed what people typically expect from the gold sector.
Right.
If you compare us to our peers, we definitely look like we're outperforming. But when you look at our valuation across, say, all the various sectors within the stock market, I'm trading at about 1 times my net asset value. Is that really a big? That's not a premium at all.
It takes big.
Exactly. And in virtually every other sector in terms of cash flow multiples, net asset value multiples, and so forth, we're still looking relatively cheap. And what I've been hearing at the conference so far is that the deep value funds, the ones that typically have ignored gold, they have identified gold right now as one of the real deep value plays. And not only are they buying into gold, they're buying into gold equities, and frankly, they're buying into Alamos. So our name is starting to pop up in these funds where you'd never see that 3 to 5 years ago.
Right. So that's looking out. The growth is all there. And the reason I do get a bit cheeky, but it's so many companies come and talk about growth, and they find it very hard to define what that means because they can't talk about reserves, etc. And you have. Let's come back down the other side of that, which is, you mentioned it earlier, you've kept your kind of cost base in check, under control compared to some. And it's still, I don't know if it's still rising environment, but the costs are a lot more than they were, significant than they were two years ago. So what are the things that you're doing in terms of the balance sheet to kind of keep that control?
Well, it's not really the balance sheet driving it. I mean, we've always had a very conservative balance sheet. We've had little to no debt at any period throughout the company's 20-year history. In the acquisition of Magino, we acquired Magino's debt, but the debt and equity combined, it made the acquisition about a $550 million acquisition, which is very, very cheap for what we've acquired. Our cash flow generation puts that as a ratio, a relatively small amount of debt, and relative to our market cap, a relatively small amount of debt. My point of view is that there's certain points in the market where you should take on a little bit of leverage, which is effectively what we've done in this transaction. I think it's something that we can handle very carefully, but growth and margins and so forth, that has little to do with your balance sheet. What it has to do with is the way you invest your capital, and what we're investing in is productivity. We're investing in a way to lower our costs in the future. How? Better technology, better equipment, larger scale. That's what's driving our
There's so many costs you can cut, so you focus on growth.
Growth, but growth that essentially allows us to bring in lower cost ounces, if you will.
Right.
So if you looked a few years back when we were coming to the end of the main Mulatos pit, Mulatos, it produced for 16 years. In the early goings, when the strip was low and the grade was high and the recoveries were good, that was a very low cost mine. But as we got towards the end, the costs went up because the grades were lower, the strip was higher, the hulls were longer, and so on and so on. That's a very natural progression of a mine. But that mine's finished. Liaki Grande came on, and that's a brand spanking new mine, and it was higher grade than even Mulatos was. Higher grade, higher recoveries. So as a consequence, we brought on very low-cost production in Mexico, and our cash flows soared. Similarly, at Young-Davidson, we took it on when it was operating at less than 4,000 tons a day. Quite inefficient, triple handling of ore and that kind of thing. With the investment that we made between 2015 and 2019, what did we do? We fully automated the thing. We pushed it to 8,000 tons a day of throughput, a much more efficient operation. And what happened? It went from relatively flat to break even to the point now where it generates over 100 million in free cash flow a year. And it's been doing that for the last 4 years. So this is how we've been doing. We're going to do the same thing now at Island Gold. We're putting in a shaft, a paste backfill plant. We're expanding the mill capacity. You do all that, and next thing you know, your costs are coming down because you're taking advantage of economies of scale and just a much more automated and efficient operation. That's how we've been able to keep our costs not just in control, but declining.
Peerless. Well done.
Thank you.
See you soon.
All right.